You know that feeling, right? You're staring at a chart, your heart's pounding, and you're asking yourself that one huge question. Is this a real trend, or is this just market noise, a fake out before everything reverses on me? Getting that call wrong is, well, it's one of the fastest ways to empty your account. So today, we're going to break down a classic tool designed to answer that very question. Look at this. You see that big green candle pop up? The FOMO kicks in, you feel that urge to just jump right in. But hang on, is this really the start of a powerful new rally, or is it a classic bull trap just waiting to snap shut and take your money? See, that uncertainty, that's the gap between just guessing and making a calculated trade. So how do we get a real, objective read on the market's power? Well, this is where the average directional index, or just ADX, comes into the picture. It was developed way back in 1978 by trading legend Wells Wilder. Yeah, the same guy who gave us the RSI. He basically built this thing to be a strength meter for whatever trend the market is in. So what is it exactly? At its core, the ADX is a trend-following indicator. Its one and only job is to tell you how strong a price move is. It's not trying to be a crystal ball and predict the future. Think of it more as giving you a real-time report on the horsepower behind the current price action. And listen, if you only remember one thing from this whole explainer, make it this. The ADX is a speedometer, not a compass. It tells you how fast the car is going, but it does not tell you if it's headed north or south. So a really high ADX reading could mean a super strong uptrend or a super strong downtrend. It just cares about the raw power. So to really get how it measures strength, you gotta look under the hood. The ADX isn't just one line. It's actually a system of three. I want you to think of the plus DI and minus DI lines as a constant tug of war. You've got the plus DI, let's call that the green line, representing the bulls, and the minus DI, the red line, representing the bears. The third line, the ADX itself, well, it's just watching that fight and measuring how intense it's getting. And we read that intensity on a really simple scale, from 0 to 100. Now, the magic number here, the one you really need to pay attention to, is 25. If the ADX is hanging out below 25, the market's pretty much asleep. It's weak, it's choppy, it's ranging. But once that ADX line starts climbing above 25, that's your signal. It's telling you, hey, wake up, a strong, tradable trend is starting to form. Okay, so that's the theory. We get what the pieces are. But now let's get to the good stuff. How does this actually translate into making better trading decisions? The ADX's first job is to be your market weather forecaster. If the ADX is over 25 and, importantly, it's rising, you are in a trending market. This is go time for trend-following strategies. But if that ADX is below 25, that's a huge red flag. It's basically screaming at you, this market has no direction. Trying to chase a trend in that environment is a great way to get chopped to pieces. So here's the classic ADX play. Step one, and this is the most important part, you do nothing until the ADX gets above 25. You wait for that confirmation of strength. Only then, once you have it, do you look at the DI lines. If the green plus DI crosses over the red minus DI, that's your potential buy signal. And if the red minus DI crosses over the green plus DI, that's your potential sell signal. The ADX is your filter. It tells you when those crossover signals are actually worth listening to. You know, the ADX is also fantastic for validating breakouts. Let's say a price smashes through a key resistance level. You want to look down and see that ADX line rising too, hopefully above 25. That tells you there's real power, real conviction behind that move, which makes it way more likely to be a real, sustained breakout and not just a quick fake out. All right, let's get real for a second. No indicator is perfect, and if you want to use a tool the right way, you have to respect its weaknesses. So let's talk about why the ADX is not, and I repeat, is not, a magical holy grail for trading. First off, the ADX is a lagging indicator. It's built using past price data, so by its very nature, it's always looking in the rearview mirror. That can mean getting into trades late and getting out of them late too. And as we've said, it's non-directional. Most importantly, you absolutely cannot use it by itself. Just trying to trade off the ADX alone is a recipe for disaster. And this leads to a super common trap, which was put perfectly by this Reddit user. Overfitting. You've probably seen this. It's when a trader keeps tweaking an indicator's settings on old charts until it looks like it would have made them a millionaire. You end up with a strategy that was perfect for the past, but is pretty much useless for the live market. So, what's the answer to all these weaknesses? It's not about throwing the ADX out and looking for a better indicator. The real solution is to build a team.
We can make up for the ADX's blind spots by pairing it with other tools that can confirm its signals.
The name of the game here is one word: confirmation. That's it. What we want is for multiple, different kinds of indicators to all be telling us the same story. When your strength meter, the ADX, agrees with your direction finder and your momentum oscillator, your confidence in that trade setup just goes through the roof. So who are the best teammates for the ADMEX? Well, moving averages are perfect because they do the one thing the ADX can't: tell you the trend's direction. The RSI is amazing for timing your entry, helping you buy pullbacks in a strong trend. And the MACD, that gives you another layer of confirmation on both the direction and the momentum.
Okay, theory is great, but let's put this all together. What does this multi-indicator checklist actually look like in a practical, step-by-step trading scenario?
Let's walk through it. Check 1. The ADX is at 30 and it's rising. We have a strong trend. Check. 2. The price is trading above key moving averages, like the 50 and the 200. That tells us the trend is up. Check. 3. The RSI is rising, showing good momentum, but it's not overbought yet, so there's room to run. Perfect timing. Check. And finally, 4. The MACD has a bullish crossover, confirming that buying pressure is building right now. With all 4 indicators pointing in the same direction, now we have a high probability, high confidence setup. So after all this, what's the big takeaway? Indicators like the ADX are not a crystal ball. They will never predict the future with 100% certainty. A much other way to think about them is as a really, really good flashlight. It can't show you the final destination at the end of the path, but it can light up the next few steps brilliantly, helping you navigate the dark with way more clarity and confidence. The real question is, how are you going to use that light?